On September 17, 2025, the Bank of Canada cut its benchmark rate to 2.5%, the eighth consecutive reduction since mid-2024. Within hours, mortgage brokers across Ontario began fielding desperate calls from homeowners whose refinancing applications had been rejected. Their properties, once valued at premium prices, were now appraising for hundreds of thousands less than expected. The gap between market expectations and appraised values had widened into a chasm that was trapping families in financial limbo. But behind this appraisal crisis lies a deeper problem few are talking about. The numbers paint a stark picture of a market in systematic decline. According to the Canadian Real Estate Association, Ontario home prices have dropped 3.7% annually as of June 2025, with the provincial average sitting at $852,036. But this figure masks the severity of regional variations. In Hamilton, benchmark prices fell nearly 8% from June 2024 alone, while Greater Toronto area homes declined 5.5% year-over-year by September 2025. The composite benchmark price for Canadian homes has plummeted 17.2% from its March 2022 peak, creating what real estate professionals are calling the largest valuation gap in 3 decades. The Municipal Property Assessment Corporation, Ontario's Property Assessment Authority, has compounded the crisis by freezing assessments at 2016 values. This 8-year assessment freeze has created a fundamental disconnect between actual market conditions and official property valuations. While MPAC captured over $42.7 billion in new assessment value in 2024, this represents new construction rather than reassessed existing properties. The result is a dual-track system where property tax assessments remain artificially low, while market appraisals reflect current declining conditions. Real estate appraisers across Ontario report unprecedented challenges in establishing accurate property values. The traditional comparable sales approach, which relies on recent transactions within a defined geographic area, has become increasingly unreliable as market volatility creates month-to-month price swings. Appraisers note that properties selling in January 2024 may be worth 15 to 20% less by year-end, making historical comparables largely irrelevant for current valuations. The discrepancy between MPAC assessments and mortgage appraisals has created what industry experts term a valuation trap. Homeowners expecting their properties to appraise based on tax assessment values or 2022 peak prices are discovering that mortgage lenders now require appraisals reflecting current market conditions. This gap has led to thousands of failed refinancing attempts and collapsed real estate transactions across the province. Professional appraisers report that lending institutions have tightened valuation standards significantly since early 2024. Banks now require multiple comparable sales within a 3-month window, eliminating the previous 6-month standard. This compressed time frame, combined with reduced transaction volumes, has made accurate appraisals increasingly difficult in many Ontario markets. The result is a conservative bias that further depresses property valuations, creating a feedback loop that accelerates market decline. Sarah Chen stares at the laptop screen in her Burlington kitchen, the mortgage refinancing rejection letter still displayed in her browser. She had expected her 3-bedroom townhouse to appraise for $750,000, close to its $780,000 purchase price in late 2022. Instead, the appraiser valued it at $620,000 in August 2025. The $130,000 difference meant her equity had evaporated, leaving her unable to access the home equity line of credit she needed for her daughter's university tuition. "I knew the market had cooled," Chen says, "but I never imagined losing that much value in less than 3 years." Across the province in Windsor, construction foreman Michael Rodriguez faces a different but equally devastating scenario. His 200-square-foot bungalow, purchased for $485,000 in March 2022, appraised at $378,000 during his recent refinancing attempt. The $107,000 decline pushed his mortgage underwater, meaning he owes more than the property is worth. Rodriguez had planned to leverage his home equity to start his own contracting business, but the appraisal gaffe trapped him in his current employment while his entrepreneurial dreams remain on hold. The human cost extends beyond individual financial planning. Real estate agent Lisa Thompson in Hamilton reports that 60% of her client transactions since July 2025 have involved appraisal shortfalls, where mortgage appraisals come in below agreed purchase prices. Buyers are scrambling to find additional down payment funds or walking away entirely, Thompson explains. Sellers are reducing prices mid-transaction just to keep deals alive. The uncertainty has paralyzed market activity, with many potential buyers and sellers choosing to wait rather than navigate the valuation minefield. Government and industry officials have begun acknowledging the severity of the appraisal crisis. In August 2025, Ontario Finance Minister announced a $15 million emergency fund to support homeowners facing refinancing difficulties due to appraisal gaps. The Canada Mortgage and Housing Corporation issued guidance allowing mortgage renewals based on original purchase prices rather than current appraisals, provided borrowers meet specific criteria. These measures represent official recognition that the valuation system has become dysfunctional. The Appraisal Institute of Canada reported a 40% increase in valuation complaints during the first half of 2025, with the majority originating from Ontario. Professional liability claims against appraisers have doubled year over year, creating additional pressure on valuation professionals already struggling with volatile market conditions. The Institute has recommended enhanced continuing education requirements and standardized methodologies to address growing concerns about appraisal accuracy and consistency. Federal banking regulators have responded by mandating additional oversight of residential appraisals for mortgages above $500,000. The Office of the Superintendent of Financial Institutions now requires secondary appraisal reviews for properties showing year-over-year value declines exceeding 20%. This regulatory response, while intended to protect lenders, has further slowed the approval process and increased costs for borrowers already struggling with affordability challenges. The appraisal crisis reflects deeper structural problems within Ontario's real estate ecosystem. The province's decision to indefinitely delay property tax reassessments has created a fundamental disconnect between different valuation systems. While MPAC assessments remain frozen at 2016 levels, mortgage appraisals must reflect current market conditions, creating parallel universes of property value that confuse homeowners and complicate financial planning. Interest rate volatility has amplified these structural issues. The Bank of Canada's aggressive rate hiking cycle from 2022 to 2024, followed by equally dramatic cuts in 2025, has created unprecedented market uncertainty. Appraisers report that traditional valuation models, designed for more stable interest rate environments, struggle to account for rapid changes in borrowing costs and their impact on property demand. The compressed sales volume across many Ontario markets has reduced the pool of comparable transactions available for appraisals. In some suburban markets, monthly sales volumes have declined by 40 to 50% compared to 2021 levels. With fewer recent sales to analyze, appraisers increasingly rely on older comparables or properties from different neighborhoods, reducing accuracy and increasing the potential for valuation disputes. Demographic factors compound the challenge. The influx of international buyers during the pandemic created artificial price inflation in many markets, particularly around Toronto and Ottawa. As foreign investment has declined due to new taxation measures and global economic uncertainty, these markets are experiencing correction pressures that make historical sales data less reliable for current appraisals. Geographic analysis reveals significant variation in appraisal challenges across Ontario regions. The Greater Toronto Area, with its complex mix of urban condominiums and suburban single-family homes, shows the most severe valuation gaps. Downtown Toronto condominiums have seen appraisal shortfalls averaging 12% below 2023 valuations, while suburban markets like Mississauga and Vaughan show smaller but still significant declines. Northern Ontario markets present different challenges entirely. Cities like Sudbury and Thunder Bay, with limited comparable sales data, rely heavily on older transactions for appraisals. The result is valuation instability that makes mortgage financing difficult, even when local economic conditions remain relatively stable. Rural properties face additional complications, as appraisers struggle to find adequate comparables within reasonable geographic boundaries. Hamilton and the surrounding Golden Horseshoe region demonstrate how industrial economic factors influence appraisal challenges. The decline of traditional manufacturing and uncertainty around future employment has created downward pressure on property values that appraisers must consider. Properties near industrial zones show particularly volatile valuations as appraisers attempt to account for changing economic conditions and environmental factors. Southwestern Ontario, traditionally more stable than the GTA, has experienced its own appraisal difficulties. Cities like London and Windsor have seen modest price declines that nonetheless create financing challenges for homeowners expecting stable or growing values. The agricultural transition affecting rural areas has added complexity to property valuations, as appraisers must consider changing land use patterns and their impact on residential properties. The appraisal crisis raises fundamental questions about Ontario's housing market stability and the reliability of property as a store of wealth. If current trends continue, the province may face a prolonged period of depressed real estate activity, as buyers and sellers struggle to agree on property values in an environment of assessment uncertainty. Financial institutions may respond by implementing more conservative lending practices, further restricting mortgage availability, and potentially accelerating price declines. The feedback loop between restrictive appraisals and reduced market activity could create the synchronized shock that economists have warned might trigger a more severe market correction. Policy responses remain uncertain as government officials balance competing interests. More aggressive intervention to support property values risks creating moral hazard and delaying necessary market adjustments. However, allowing the appraisal crisis to continue could undermine confidence in real estate as a reliable investment, with broader implications for household wealth and consumer spending. The technological disruption of traditional appraisal methods presents both challenges and opportunities. Automated valuation models, increasingly used by lenders for initial assessments, may provide more consistent valuations but lack the nuanced understanding of local market conditions that human appraisers provide. The integration of new technology with traditional appraisal expertise will likely determine how quickly the industry can adapt to current market volatility. Professional development within the appraisal industry must evolve to address current challenges. Traditional appraisal education, designed for more stable market conditions, may inadequately prepare practitioners for the complex valuation scenarios now common across Ontario. Enhanced training in volatile market analysis and alternative valuation methodologies could improve accuracy and reduce the disputes currently plaguing the system. From September 2024 to September 2025, Ontario home prices declined 3.7% annually, while appraisal gaps widened to unprecedented levels. The Bank of Canada cut rates 8 consecutive times from 5% to 2.5%, yet appraisal challenges continued constraining market activity. MPAC assessments remained frozen at 2016 values, while mortgage appraisals reflected current declining conditions, creating valuation discrepancies averaging 15% across major markets. The provincial government allocated $15 million for refinancing support, while federal regulators implemented enhanced oversight for high-value appraisals. These interventions represent official acknowledgement that Ontario faces a systematic valuation crisis that extends far beyond normal market corrections. The resolution of this appraisal gap will likely determine whether the province experiences a managed market adjustment or a more severe correction that reshapes real estate ownership patterns for years to come.